Good afternoon, everyone, and welcome to the webinar hosted by Kampani Capital on fundraising opportunities and fund structures in global markets. We thank you for taking our time for the first webinar in a series of sessions planned by us for this year. We at Kampani Capital firmly believe that the Indian economy is at the cusp of an exponential leap over the next 5 to 7 years, and the roaring 20s will be India's decade. India is emerging as a shining star in the global economic map, with the IMF predicting India's growth rate at nearly 6% for 2023 as compared to the global GDP growth rate of 2.8%. We are seeing strong sectoral growth trends emerging in industries like passenger vehicles, hotel and leisure, airlines, and renewable energy being some of the key examples. Another key economic indicator which came out recently was the record export numbers we saw in 2022-23, where the total merchandise plus service exports touched $770 billion, and our next target of $1 trillion is firmly in sight.
On the market side, we continue to see robust numbers on both the inward side as well as outbound flows. While there are signs of a slowdown on the private market side, once you reach Series B, but there is tremendous optimism on India in the international markets, which I am sure will ensure a quick bounce back. We saw close to 8,000 crore of FPI inflows in March 2023, and also are beginning to see early signs of energy coming back in startup investments. I can safely tell you that during all our global roadshows, there was a lot of optimism on investments in India, as well as the Indian firms investing overseas, a level of interest which I last maybe saw in the pre-Lehman days. With that backdrop, let me now introduce our esteemed panel of speakers. We are happy to welcome Mr. Sandeep Shah as the keynote speaker for our session. Sandeep heads the GIFT IFSC at Gandhinagar in Gujarat and has been instrumental in growing this region as a hub for finance activities ranging from banking services, fund management, insurance, capital markets, and more recently shipping and aviation finance. Sandeep is a close friend with a tremendous focus on business, and I have now known him for more than 6 years. I would now like to hand over the floor to Sandeep to talk more about the exponential growth in the GIFT ecosystem and how it is fast becoming the gateway for cutting-edge finance in India. Over to you, Sandeep.
Thank you, Amar. I think we have done a lot of events with Amar, webinars, roadshows, and conferences, but I think this is a new beginning with Amar, with his new venture, Kampani Capital, and I'm sure it will go a long way for developing the right kind of ecosystem for India. I think, we have always talked about how do we raise capital investments for the investments in India. There are enough opportunities in India in terms of the investments, whether we talk about private equity market or the public markets. But I think the question is now, how do we help the Indian fund managers looking to raise money from the international markets, and what is the right way, what is the right jurisdiction, and how does it help basically in terms of the distribution network to be a part of the entire ecosystem. So I think this is where the today's discussion will throw lights, and how GIFT City can actually be enabler to many of these activities that we are going to talk about today. But let me take this opportunity in terms of highlighting Government of India's intention agenda for developing the IFSC in India. And this is how every financial market entity is now talking about how do we access IFSC, so that it helps to access not only India but the international markets. But for the benefit of the new members, participants who have joined today, GIFT City is located in the state of Gujarat, closer to Ahmedabad International and Domestic Airport. This is Government of India's kind of initiatives to develop international financial services center in the country. And that's where the entire ecosystem, whether you talk about regulations, infrastructure, the tax incentives, and even the dispute resolution mechanism, have been aligned in such a way that India comes out with the leading financial center and provides the right kind of platform, not only to access Indian market, but also the international markets. And when we create that ecosystem, it is very important that the regulations are aligned with the industry requirements, and not only the industry requirement, but it is also aligned with the international markets. The taxation regime is also important, because while tax incentives are important, but at the same time, it is also important that there is a tax certainty and tax clarity on the transactions which are happening from particular jurisdiction. So today I'll be speaking more on the jurisdiction, which is a new India's new jurisdiction, which is IFSC, and how people have already started utilizing the financial center to access these markets. And there are multiple new business opportunities for various domains. And I think probably we have always spoken on the AIF regime more from the private equity investment and the public markets. But I think today Gift City provides new opportunities in couple of segments where dedicated funds can also be established to cater to the requirements of some of the industries that we are going to talk about. But Gift City, I think it's very interesting concept, and many of you, I'm sure, we have visited the city. It's a greenfield project, and it's an integrated city. What we are creating here is the state of the art infrastructure, and we are trying to provide walk to work concept here. So people working here can actually stay within the city. That's how it's being built, and today more than 22 million square feet of space has already been allocated, and uh, 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 close to more than 4 million square feet of space is up and running in the city. Uh, the heart of the city is the International Financial Services Center. And when we started in 2015 as IFSC, it started with three basic activities: banking, insurance, and capital markets. And real intention was to provide inbound and outbound gateway basically for investors to access the jurisdiction, not only India and, as I mentioned, the international market. And with that objective, Government of India started working in terms of creating the right kind of regulations. And I'm happy to share that today, when we are talking, close to 23 banks have already set up their offshore branch. And this includes the leading foreign banks like Standard Chartered, HSBC, Deutsche Bank. They have set up their offshore branch and they are providing foreign currency business from here. Similarly, there are more than 23 insurance firms providing reinsurance and reinsurance broking from here. Uh, Capital market entities, two international stock exchanges operating 22 hours a day. And I think today, major announcement which has been made, all of you may be aware, the Singapore Exchange has made a press release where the connect between as Singapore Exchange and the NSE, through which now the Nifty trading will be happening from the NSE Gift Exchange, and it is expected to be live from 3rd of July. So I think this is a big announcement where the liquidity, Nifty liquidity, will now move to NSE Gift Exchange, and which will actually provide opportunities for many hedge funds to uh, trade as well as hedge their equity risk through the NSE platform in Gift. Additionally, there are capital market intermediaries operating here, and alternative investment funds. We will discuss more in detail about the funds, how they have structured their business here. But let me focus on a couple of new business activities which we have not heard of, initially in India, and this is first time happening today from Gift City. And these activities include one, the aircraft leasing and financing kind of activities. Probably, India is, as we all know, it's one of the largest market for the aviation, and I probably the entire leasing of such aircraft was not happening because of certain reasons. But now today we have right kind of regulations and tax through which aircraft leasing entities can be set up, which can actually import the aircraft on its book, and it can give it on lease to the Indian player as well as to the international players. And probably, while prima facie it looks like an aviation business, but typically it's a financial model where the entire leasing of such transaction is happening today from Gift. And how do you as a fund manager or as a family office, how you can be a part of this ecosystem is one, can you create a dedicated fund to invest into such aircraft leasing companies? I think many of such companies are looking for right kind of investment funding where and these are very fixed income, fixed rental generating assets. And this is something which you may like to evaluate more from the investment perspective, if you can invest as an equity into the company or if you can invest into the assets of such companies. The these around close to 15 aircrafts have already been leased from Gift City today. So this is something which we are talking, which is already happening from the zone. And I think it's a great opportunity for many of the fund managers to look at. Also, for more from the distributor's perspective, because such lenders are today may not be available in India. But how do you provide access to the offshore lenders to provide access to such aircraft leasing assets, and that is something we would like to encourage all of you to look at. Similar such second asset is the ship leasing business, and probably again, India is a major market where many of the ship owners and ship charterers are today based in some of the other jurisdictions. Now, with the today's regulation and tax framework, many of such companies have already started creating structures here. They are importing ship basically on their assets, and they are providing it on lease to the many players. Again, there are investment opportunities for many of you to look at this segment as well, in where you can invest into the assets of the ship leasing companies in GIFT City. And probably the another couple of segments where fintech is something which we are working, and it provides two kinds of entities to access. One, there is a sandbox regulatory regime available in gift. You can, if the product is not matured and you want to still be a part of the regulated environment in a closed door environment, then you can access through the sandbox environment. You can register, be a part of it, and once you feel that product is matured enough to go to the market, you can get the direct authorization as well. And the good part is fintech is not limited to only fintech. It actually enables you, if you have a product related to health tech, agri tech, space tech, where there is a financial services angle. I think many of such products can be innovated through this platform, and we are actually encouraging such companies to come and access the market. The good part is it provides you very easy access to the international market. A fintech product can easily access international market, and there are regulator to regulator, there are arrangements as well, where the access to the another international market would be very easy with the arrangement made by the regulators. So I think if you are into a product, fintech product, where you want to access the international markets but sitting in India, IFSC is the right platform. And similarly, the international fintechs will have easy access to India without going through a domestic approval process. The unified regulator based in GIFT City will provide the license, and you can access the domestic market as well. Now, coming back to the our core topic today about the apps, the how do we create the right kind of structure through the GIFT City, as well as within this structure, what are the other new opportunities which one can look at. And the third aspect is basically about the distribution network, and this that is something which is very interesting today, and I think Amar will discuss more about it, because this is emerging and this is right opportunity today GIFT City provides, where the distributor can easily access both the markets without any restriction. So first, apps, I think all of you know that the regulations have now settled down, and the fund management entity is now regulated at GIFT City instead of a fund. And once you establish fund manager entity, you have freedom to create funds and schemes. It doesn't talk about cat 1, cat 2, or cat 3. So once we have recognized as one of the fund manager entity, you can create private equity fund, you can create hedge fund, depending on your business model. So I think it provides you freedom as well as a low cost jurisdiction where you structure the fund, plus no restrictions in terms of investing in international markets. So you can invest 100% money overseas, you can invest 100% in India under FPI route or FDI route, and the regulations that will apply will be of IFSC authority. So the unified regulator based in GIFT City, you need to only go through their regulations basically. Now, within the FME regulation, one of the segment that I would like to touch upon today is the family office segment as well, because it allows you to set up self-managed family office fund as well, where overseas family office can set up a fund here in GIFT as a self-managed fund and can invest in India in private equity as well as public markets. Similarly, even Indian family office can set up a family office fund here in GIFT, invest money under the OPI route of the RBI, and invest basically in the international markets. So I think it's becoming now a reality. Couple of family offices are now setting up, they have already applied. So you will see after the fund regime, where already 60 funds are registered today, more than $10 billion has already been committed from GIFT City, which shows the confidence of the foreign investors as well for the jurisdiction. And the good part is couple of funds registered in GIFT City have also raised money from the sovereign fund managers as well. So I think that is again important that the sovereign funds have also started investing through the GIFT City structure. And probably I think the next similar growth we are seeing is in the family office space, and probably that is something which one would like to look at. And while these 60 funds have registered today, the all of these funds are looking to also raise money from the international markets. And many of these funds are also new age funds. So the new portfolio managers, the new entities have also established. Probably they have the expertise of managing the fund, but I think they also need help in terms of how do they raise money. So probably the distributors will play a very important role to provide them the access to the NRI investors, to the foreign investors for investment through the GIFT City in a fund and invest back in India, because their expertise is in managing the fund and not in terms of raising of fund. So probably that's where many of you will play important role to provide the access. Let me in my the last point I would like to highlight that while the banks are operating and mostly the products are wholesale banking products, but many of these banks have also started providing retail products. And today these banks have opened thousands of NRI accounts today through the GIFT IFSC, and these NRI accounts have also opened deposit accounts with banks. And probably that's where this fund is also now looking for investment products. And that's where if you can create a right kind of distribution network, this NRI money can actually get a right kind of investment products to invest in India as well as in the international markets. So I think and the network of service providers, I can see the Apex official here as well. The right kind of service providers have also set up their office here. So when we are talking of a fund, the fund admin, fund accounting, legal firm, service providers, they are all today based in GIFT City. And that has created a complete ecosystem for the fund today in GIFT City. And probably the next important stakeholder is the distributor. And that's where we are going to see a big role of distributor in the entire ecosystem that is being created today. Now with this, I'll pause here, and I wish all the best to Amar and team for organizing this wonderful interaction today, and I look forward to engaging with all of you going forward as well. Thank you very much.
Thanks a lot, Sandeep, for the very useful session. GIFT has always been special to me, and it's heartening to see this growth. If there are any questions, may I please request participants to drop me a message on the chat box. Sandeep will be happy to answer them once the presentations are over. I would now like to warmly welcome Rajesh Gandhi, Senior Partner at Deloitte India, to our session. Rajesh has more than 25 years of experience in domestic and international tax, SEBI and exchange-controlled regulations, advising clients on various tax issues, including domestic and international tax planning, inbound and outbound investment structuring. He is also a member of the HR Khan Committee set up by SEBI to facilitate ease of doing business for global investors. He is also a close friend and a well-wisher of Kampani Capital, with a special interest in creating solutions for clients. Over to you, Rajesh, to talk about the possible fund structures for fund managers in GIFT IFSC and also the aspects covering taxation.
Thank you, Amar. Thank you very much. And as Sandeep rightly put in, we are talking in public forum with you for the first time in your new avatar. And we wish you all the best in what wonderful initiative you have taken. And you have tried to bridge an important gap which is there in the industry today. So best of luck to you. And always a pleasure and honor to be on the same forum as Mr. Sandeep Shah. He's a good friend. We call him Sandeep Bhai. He's been always very forthcoming, always takes our calls and tries to solve whatever problems the industry has. So thank you very much, Sandeep Bhai. So I'll not probably take much time between Sandeep Bhai and the other speakers. I think this presentation is essentially about distribution. So I don't want to stand in between, though I'm tempted to speak for at least half an hour. If you see the slides, there's a lot of material, but I'll only try and talk about some of the relevant things, highlight some of the important things. So as we know now, and just to refresh, the new IFSCA framework provides for registration of the fund manager entity rather than the fund. Unlike in the domestic area where the fund has to be registered, and which means every time you set up a new fund or a new scheme, you need to go to SEBI. As against that, the IFSCA follows an international approach where the FME or the fund manager entity would be registered, and each fund would only have to then be intimated to IFSCA and would not have to be separately licensed or registered. And within the framework, the FME framework, there are multiple subsets. So there is the authorized fund manager entity, which is more for startups and private kind of investment. There's a registered FME license, which is for non-retail, which is akin to our AIF license, which we will talk about a little bit more detail. And then there's a registered FME retail, which is more for mutual funds. And the regulations also have subset of regulations for PMS, investment management trust, family offices, and also various kinds of schemes like a venture capital scheme, retail scheme, special situation funds. So depending on what you want to do, there are a subset of regulations which once you comply, you can set up multiple schemes. This is a typical structure for an AIF fund. So typically you would have foreign investors in the fund, investing in either foreign securities. You could invest in securities of listed on the IFSC, or you could invest in domestic securities. The fund regime requires the manager to be based in the IFSC physically. It can either be a branch, it can be a subsidiary of a holding company in India, it can be a subsidiary of a foreign company. So there is a flexibility around that, and there are certain pros and cons which will depend on the facts of each case in terms of how you want to set up the fund manager entity in the IFSC. You need to have a trustee. The trustee can be outside the IFSC. And you could also have resident investors putting money under the LRS route, which allows each Indian resident to invest $250,000 per year. So if you're a family of 4, you can invest $1 million into an IFSC fund. But the only restriction there is, since India does not encourage round tripping, when you use the LRS route, the funds need to be used for investing in foreign securities. This is a gist of the regulations. I don't think I need to spend time. This is, they speak for itself. To some extent, the regulations are similar to the domestic AIF. For example, the minimum ticket size, which is 1,50,000, which is similar to the 1 crore limit here, and 40,000 or 1/4 of that limit for employees or directors, etc. One difference is there's a minimum net worth requirement of 500,000, unlike the domestic area where there's no minimum net worth requirement. The other important thing is that you need to have 2 KMPs. In the domestic area, we have moved away to some extent from an experience requirement, and the new SEBI regulations say that the KMP needs, as well as the compliance officer needs to pass an examination. Most likely it will be the NISM examination. The IFSC regulations require the 2 KMPs, one to have qualification, which will be a which will be a postgraduate degree of at least 2 years. And the second will be an experience of at least 5 years in securities market or related products. An important clarification which was given when the IFSC regulations were finalized, when the draft regulations were finalized, is in terms of the key activity which you need to conduct in the IFSC. And many times, if you have an entity in Bombay or even abroad, which is involved in the fund management activity, then the question comes in, what part of the activity should be done within GIFT? So the final regulations say that the proposal for the portfolio composition should be initiated by a person who is based in the office of the FME in the IFSC, which means the decision to invest in a particular portfolio should be initiated by the fund manager or the KMP sitting over there. And some of the ancillary activities, or maybe even fund accounting or certain ancillary activities, depending on the structure, depending on the volume of investment, depending on the type of investment, can be conducted outside the IFSC. Of course, I'm speaking maybe on behalf of Sandeep Bhai, but I think it is important that the 2 KMPs should be there in the IFSC. I think sometimes we see that the IFSC officials might come and visit, etc. in future. So whatever is the base requirement, I think that certainly should be complied with. Certain other regulations, again, I'll not go through in detail, maybe a couple of things. Skin in the game, there is a requirement of sponsor contribution, which can be waived off with investor consent. Or if you're moving a fund from abroad into the IFSC or migrating a foreign fund, then you don't need sponsor contribution. But otherwise, there's a minimum and maximum limit. Maximum because, again, the government does not want to encourage round tripping. So there's a maximum limit of 10% up to which sponsors can contribute into the corpus of the IFSC fund. One good thing is that there is full leverage permitted, subject to disclosure in the PPM and consent of 2/3 investors. So which is a big move away from the domestic regulations, which do not allow leverage, except for a Cat 3 fund, which allows a 2:1 leverage. And this may actually potentially prompt a lot of hedge fund investments, derivative investments, or even P-note structures. And we'll talk about that a little bit if we have time to use the IFSCA framework for setting up a fund over there. The procedure for setting up a fund, again, I'll not go through that. These slides will be with you. So basically, you need to take an office or identify an office in the GIFT city. Then you need to set up the fund manager entity, which could be a company or LLP or a branch, as I said. After that, an application has to be made to the SEZ authorities. Of course, that will be merged now after budget announcement, where the SEZ approval and the IFSC approval will be combined into one. You need to finalize the fund documents, which is the PPN, contribution agreement, investment management agreement, trust deed. Then apply for a tax registration for the fund and the fund manager, and then apply to the IFSCA for obtaining registration as a fund manager entity and file the PPN. And once the license is obtained, if you want to invest in the domestic area, you need to go to the custodian and also get a FPI license. The process normally can take anywhere between 1.5 to 2.5 months in total. Okay, so talking briefly about the tax key, and Sandeep Bhai, as rightly mentioned in the beginning, tax is one of the important considerations, though not the only driver, but a key consideration which fund managers can look at when thinking about moving to the IFSCA. So one is that there is complete tax exemption for the manager on any management fees, carry, etc., whatever is received for 10 years out of 15 years. Of course, there's a MAT of 9%, but if the fund manager is set up as a company and it opts for the 22% concessional rate under domestic law, then even MAT is not chargeable. So therefore you have complete exemption on any carry income or management fee income of the manager. And then when the manager, suppose if it's a branch, then there's no dividend tax. But if the manager is set up as a company and when it distributes dividend to the parent, there is a dividend tax on that. But then there's a set-off available under Section 80M, so that there's no double taxation when the shareholder of the manager distributes the dividend further to the ultimate shareholders. On debt, there is a concessional rate available at 9%. And as some of you would know, that India had a regime of 5% interest on domestic, certain kinds of domestic debt and GSECs, which in this budget 23 was increased to 20% or even 40% in some cases. In the IFSCA, if you have some bonds listed on the IFSC exchange, then the rate is lower at 9. This is one of the lowest rates on interest you would get. The India-Mauritius Treaty provides for a 7.5 rate. Most of the treaties give you 10 to 15% withholding rate on interest. The IFSCA gives one of the lowest rates of 9%. There is exemption from indirect taxes, so no GST or customs duty on imports, on domestic procurement, no GST on any services procured by the IFSCA entity, which is the fund manager entity, etc. Similarly, there's no securities transaction tax, no commodities transaction tax, or stamp duty on any transactions carried in the IFSC exchange. And as Sandeep Bhai mentioned, after the connect with SGX on the Nifty, we will certainly see more action on the trading in the IFSC exchange, or especially on the Nifty. And there, these exemptions will help investors. Tax on distribution, this is something in more detail on the offset. I will not talk about that. The tax exemption to the fund itself. So the fund in the IFSC could be set up either as a Cat 1 or a Cat 2 fund, and this nomenclature is more from a tax point of view, as Sandeep mentioned. Now, from a FME regime in IFSC, there is no categorization. So from a tax point of view, you would still be either a Cat 1, 1 or 2, or a Cat 3. 1 and 2 is transparent, which means the investor is liable to tax, which also means that investors who come from a treaty jurisdiction will be able to get treaty benefits either on capital gains or interest or dividends. But the most attractive tax exemption is for a Cat 3 fund, where there's complete exemption from any capital gains tax on foreign securities, gift city securities, domestic securities, except capital gains on sale of shares. There's a concessional rate of tax of 10% on dividend and interest, and foreign investors don't have to file any return or get any PAN, which I think adds icing to the cake and makes the regime similar to many of the offshore regimes. Why set up a fund in the IFSC as compared to popular jurisdictions? So one is, as I said, the tax framework now is pretty much similar to some of the best frameworks you would see in Mauritius, Singapore, Ireland, where there's complete capital gains tax exemption on non-equity and the lowest rate of tax on dividend and interest at 10%. The other thing is that if you set up an IFSC fund and you invest domestic, you have to obtain an FPI license. And under Indian law, FPIs, which are governed by domestic law, are exempt from anti-avoidance rules. So GAR does not apply. And also, since you're not claiming treaty benefits, the OECD BEPS principal purpose test also does not apply, which means you have much more peace in terms of any potential risk from the tax authorities trying to challenge your structure. There can be savings in operating and setup cost, savings in direct and indirect tax for the manager, as I mentioned, and also no indirect tax exposure on any carry which accrues to the manager, which otherwise if you set up in the domestic area, there can be issues around in the carry. Quickly moving on the relocation, I'll not spend time on this, but just to let you know, there is a sunset of March 31st, 2025. If you relocate an offshore fund before that date to the IFSC, there is complete regulatory and tax neutrality, both for the fund and for its investors. Let's look at a couple of structures. I think I'll take a couple of minutes more and then pass it back to Amar. So one is, you could have a fund of fund structure in the IFSC, which means you could have a fund in the IFSC, which invests in a domestic fund in the AIF, which in turn invests in Indian securities. There are two essential benefits of suggesting this structure. One is, and both are from a regulatory perspective. One is that if the IFSC fund invests in a domestic fund, then the investment is not made under the FPI route, which means the NRI condition of 25%, 50% does not apply. So technically, you could have 100% NRIs coming in an IFSC fund, which then invests in a domestic AIF, and then the domestic AIF invests in Indian securities. And also, if the domestic AIF is owned and controlled from India, then even the FDI norms don't apply, even though the money is coming from a IFSC fund and ultimately from foreign sources. The tax implication would depend on how you classify the AIF fund, how you classify the IFSC scheme. So there are certain permutations and combinations, and obviously we'll be happy to support on that. I will not talk about that in detail. The second option or second kind of structure is where you use a IFSC fund to invest in domestic mutual funds. Here again, you could have 100% NRI participation, because the FPI regulations say that if an FPI invests in mutual funds only, then the NRI restriction of 25%, 50% does not apply. So you could have a IFSC scheme investing in domestic mutual funds. To add to the benefit, since the IFSC fund will be a Cat 3, and as I said earlier, there's no capital gains tax on non-equity investments, there'll be complete tax exemption on income from mutual funds, which means on the sale of mutual funds, which the IFSC fund earns. So that adds to the benefit. The last is the ODI route. Sorry, this one is for pooling domestic investments. The ODI comes next. So you could set up a scheme in the IFSC, pool domestic money and invest offshore. Of course, here you don't get any tax benefits because the investors are domestic Indian investors. But nevertheless, it can be used to pool Indian money. The last is the ODI. Currently, this route is available to banking units, but I suppose as we move along, Sandeep bhai and team, might accept a request to also allow non-banking units or prime brokers to set up funds in the IFSC to issue P notes to the end clients. And as I said earlier, you get the benefit of leverage by doing this structure, and you could have tax exemption, especially with with this increase in interest rate on debt investments and the fact that you have to rely on treaty benefits. We see some amount of interest by banking units and even prime brokers to set up a P note structure in the gift and then invest in domestic debt. So that's something which could pick up in the days to come. This is a slide on difference between IFSC and some of the other jurisdictions. I will leave it, the deck. I think Amar will and team will circulate that to you. So I will leave it for your reading. I will not talk about this. And again, this is a difference between setting up a fund in the IFSC and in the domestic area. Largely regulatory benefits, as I said, no leverage limits in the IFSC, no concentration norms, etc. Skin in the game can be waived. So largely from a regulatory point of view and tax point of view for the manager, the IFSC fund is clearly better than a domestic fund. Yeah, so I think that's about it. Sorry if I was a little quick, but in the interest of time, I mean, that's about it from my side.
Thanks a lot, Rajesh, for the valuable inputs on structuring and taxation. It's always exciting listening to you with all the new stuff, and the slides keep changing every time we speak. So that's pretty exciting. If there are any questions for Rajesh, please do drop me a line in the chat box. Let me now welcome Devika Ravindran to our panel discussion. Devika is the founder and CEO of DR Partners, a boutique corporate and private wealth structuring advisory firm licensed in Dubai, but presence in both Dubai and Abu Dhabi. Her areas of focus are offshore and onshore fund structuring for regulated as well as unregulated structures, private wealth structuring, startup advisory, and equity financing. She works closely with a number of large family offices in the Middle East, providing them bespoke advisory services with excellent connects in the entire Middle East ecosystem. I now hand over to Devika to talk about some of the popular structures in the Middle East, as well as fundraising opportunities there. Over to you, Devika.
Thanks, Amar. It's a pleasure and an honor to be a part of the first webinar Kampani Capital is organizing, and also to be a panelist along with Sandeep and Rajesh, and of course, Arnaud is going to be joining. So thank you so much. Because Rajesh has given a very intense and a very detailed presentation, I'll try and keep it as generic as possible with regards to the asset and wealth management ecosystem in UAE. I've just tried to throw in some numbers in this slide for just to set a context with regards to the wealth which Middle East has been seeing, the influx of wealthy individuals or families and family offices that have come into the country. If one was to look at, and of course, everybody out here in the audience would agree that UAE has always been a very popular destination for families to move, and which has also resulted in a huge capital concentration. So there are three opportunities, the way we look at it, has arisen in UAE. Primarily, to start with, families and family offices who have moved to the region wanting to create family office structure. Like Sandeep said, this is a system, this is a trend which is seen quite often across the globe. Now, this could be families who either have structures, the new generation is looking to create structures, or as a part of restructuring, families wanting to migrate their existing operation. This has also led to a lot of professionals who have come into the region to cater to this new wealth which has come into the country. And as per the BCG report, it is expected to have the new wealth raising up to close to at least 1 trillion by 2026. So that's a very enormous number and a very attractive number to all of us who have some of the other interests with regards to fundraise. The third is, again, like Sandeep mentioned, and which is exactly where an opportunity where Amar and Soumya and I met, where they were during their roadshow, had come to the Middle East, and we were exploring opportunities of working together, helping Indian professionals try and access the current ecosystem in order to be able to raise capital. Having said that, let me just quickly touch upon the family office regime out here, which seems to be fastly growing. Again, like I said, due to the concentration of wealth that's coming. In addition, there are several features and factors which has contributed to the growth of the family office regime. The regulatory framework, of course, and quickly to touch upon certain points. While the whole world was grappling with the situation of COVID, we had UAE and make an announcement of 100% foreign ownership in the mainland, which came as a huge relief to expats and business owners who were looking to move their business to UAE. Similarly, the economic substance regulation, which was introduced, compelled most of the family office advisors, investors, lawyers, and professionals like myself to evaluate the existing family office structures these families had in the traditional offshore jurisdictions, which again led to UAE being a popular jurisdiction chosen, primarily because of the ease of demonstrating substance, be it the infrastructure, resources, skilled people, accessibility, because of which the place of effective management could be very easily shifted to UAE as a base. And of course, UAE, as you would all agree, is known for its luxurious life, the cosmopolitan life, which makes it quite irresistible for pretty much everyone. The third regulatory change, which was of great importance, which of course is still in its infancy stage, is the introduction of insolvency law, which comes as a huge relief to entrepreneurs out here because it decriminalizes the liability, especially in case of financial distress. While we talk about family offices and family wealth, I generally get asked questions as to one, which is the jurisdiction that one should look at. In Singapore, of course, is always compared with UAE, and especially for Indian families moving in, both the jurisdictions are popular, sought after. So there's always a comparison. Now, with the jurisdiction also comes a question about transition of wealth. And in the next few years, the next generation is going to be amassing a huge amount of wealth. So most of the family offices or ultra high net worth who come into the country have been getting a huge relief when they realize that there are either, at least for non-Muslims, a personal law which has been introduced, which takes care of matters pertaining to marriage, inheritance, succession, etc. Similarly, well-established legacy planning tools, which was previously a norm and a sought after product in Caribbean islands or the Channel Islands, now exist in UAE. And I'm referring to the foundation regime, which is provided either by the DIFC, ADGM, or RAC ICC. In a nutshell, family offices have been gaining popularity, and in order to support and promote them, the DIFC has also made certain recommendations and changes in law whereby the regulatory oversight which DIFC single family offices had to go through has now been taken off, and it is the scope of services has been enlarged. Having said that, family offices, quite obvious, enjoy the benefit of being non-regulated. On the other hand, moving on to the other framework, which is the fund regime, which Rajesh has also touched upon with the IFSC, UAE as well has an interesting ecosystem to govern and regulate investment and wealth management activities in the country. If one was to divide the services and the regulatory framework, we have the onshore, which is a mainland, which is excluding the free zones. Just for those who do not understand, free zones, exactly like your SEZs, were introduced in the UAE in order to promote FDI's 100% expat ownership. And only till very recently, that is 2021, did the mainland allow expats to come in, but it had to be in a combination or in partnership with an Emirati, which is a local national. So the onshore jurisdiction is regulated by SEA, which is the Securities and Commodities Authority, which took control, say, 10 years back and has been doing a great job in evolving a fund regime, which was launched in 2016, followed by the passporting, which comes in as a huge relief for DIFC and ADGM, which gives the flexibility of showcasing each fund, irrespective of where it is domiciled. And what was interesting was to know that very recently, ESCA went ahead, that is the Securities and Commodities Authority, went ahead and created a ban on foreign funds, which were previously allowed to cater to the retail investors. In a nutshell, the changes that have been recommended is that foreign funds, in order to be able to cater to the retail investors these days or going forward, will need to be either a feeder structure in the IFC or has to be licensed by the ESHCA. Most of you, I believe, out here in the audience may not be quite interested in this regime because of your interest in the alternative investment space. So moving on to the IFC and ADGM, which are the two other regulatory frameworks available. Each of them are regulated independently by the concerned respective regulators, the IFC by the DFSA, which is the Dubai Financial Services Authority, whereas ADGM is regulated by the FSRA, Financial Services Regulatory Authority. What I've tried to do is, rather than making it more technical, just to give you an overview, both these jurisdictions are common law jurisdictions with independent court. The only difference being that in the IFC, the English law has a persuasive effect compared to an ADGM, which follows law in its true essence. Both the IFC as well as ADGM allows for fund management and licensing of fund managers. And funds, the IFC and ADGM funds, can also be managed by external fund managers. The only requirement is that these fund managers will have to be from a recognized jurisdiction as per the list of each, be it the DIFC or ADGM. Mostly as a structuring specialist, most of the questions, and I'm sure a couple of you would also have these questions, like how does one decide between the IFC and ADGM? And it is a question which is generally put across to us. My first response to it is, where exactly do you intend to raise the money from? Where are your LPs? Because that plays a huge role. A structure, as some of the other speakers had mentioned, tax optimization, that's a benefit which is provided. It's a key consideration, but that's not the only consideration. But in order for any structure to take off, there has to be an investment coming in. In a nutshell, again, ADGM, though, is relatively new compared to the IFC, which has been in existence since 2004, has come up with certain light touch regulatory requirements, which might be of huge interest to some of the first-time venture capitalists that might be there in the audience today, because they have very smartly reduced the capital requirements, the expense ratio requirements as far as the VC regime is concerned. For especially real estate investors, they've also introduced a private REIT system, which allows for, or which takes off the requirement of listing, which is another Herculean task, and quite obvious. Most of our investors have an interest in real estate. So as an asset class, this is again another regime. So depending on your investment strategy, underlying your investments, one can decide, and more than happy to have a one-to-one chat about the framework and what should be your go-to path as far as both the IFC or ADGM is concerned. Just with regards to the size, I've touched upon the vintage. The IFC today has close to around 150 funds, which they have domiciled, and ADGM is not far behind. I think the number was around 100 that I last looked at. 300 odd institutions licensed in the IFC, and it's a separate ecosystem because it's just not the financial hub. It also caters to different non-regulated entities that one could look at setting up in the IFC, and the same exists in as far as ADGM is concerned. The types of funds in a nutshell, again, the whole idea is not to make it more technical, but both the IFC and ADGM allow for a public, exempt, and a qualified investor fund. Starking difference is that public funds, of course, as you would understand and appreciate, for retail clients, as well as the other two are for institutional or professional clients. And hence, this also decides, because it's retail clients, public funds are more highly scrutinized. There has to be a public offer, whereas as far as the other two could be by way of a private placement. And there are certain requirements with regards to the subscription as well. Moving on, the fund vehicles, and which is exactly my area of interest as a lawyer, which this is what excites me the most. You would have seen in some of Rajesh's slide before, the fund vehicles across, and especially some of you who might have worked with the offshore structures, the fund vehicles are relatively mimicked both in the IFC and ADGM. The most popular ones are, of course, the investment companies, and especially when it comes to real estate, REITs are preferred. PCCs, I remember, used to be our go-to structure when I started off my career way back in 2000 and early mid 2000s, where working for a fund administrator. But of course, those were the times when we used to look at a Guernsey or any of the other Channel Island structure, which is now interesting to see has become an offering within ADGM and the IFC, which of course helps fund managers in creating an asset protection structure so that the liability from one cell does not pass on to the other. 2 minutes on the structuring options. And again, going back to the point with regards to why ADGM might be considered more useful vis-a-vis the IFC, is the introduction of the ADGM special purpose vehicle regime. A couple of advantages. One is, of course, the quicker setup that can be done as far as ADGM SPVs are concerned, cost-wise, and with regards to even the ESR compliance. By just having a registered office in an ADGM SPV can comply by the substance requirements, which comes as a huge relief because it actually reduces the overheads and the cost. For those funds or fund managers who are looking at a GCC investment, certain tax treaty benefits, the fact that ADGM SPVs can also be treated as at par with GCC nationals is a huge relief. So very seriously looked upon and adopted by a lot of structures and funds. Similarly, the other holding company regime or the SPV regime that exists with the DIFC is the prescribed company, but comes with a certain limitation because unlike an ADGM SPV, prescribed company cannot be set up by anybody who intends to. There has to be a qualifying applicant or a qualifying purpose for it. A qualifying applicant could be ideally a fund. So if you look at some of the fund structures in DIFC, this is the most common underlying SPV that the funds look at. There are restricted scope companies, which provides for confidentiality as an advantage. And you also have the not so regulated or light regulatory framework jurisdictions like the RAC ICC, which provides for a holding or a SPV regime. Fees, of course, more than happy to share the slide. Just on again, a comparison, ADGM is slightly cost effective compared to DIFC as a jurisdiction. And another reason why the new entrants are looking at ADGM as an option. All of these basically was to emphasize, and I think one of the key elements or the key features to be discussed today is, and what is of interest is both the IFC, ADGM, be it any other jurisdiction, ultimately access to capital, I think is one of the worst value proposition, and that's what UAE has to offer. And if I was to go on to the capital raise ecosystem out here, and I think that's what is Amar and best area too. As Sandeep mentioned, sovereign wealth funds very actively look at investing. However, they are the big boys, bigger ticket size, have established networks. So, and access to them or an investment from them comes in with a longer duration. Having said that, there is a huge interest from the sovereign wealth fund today in UAE, and it can't be ignored that UAE today houses close to around the 5 top sovereign wealth fund, which manages close to about 1.4 trillion as assets under management. There have been certain announcement. I've just kind of managed to capture one of the transactions which happened, which is where an ADQ had invested, the Abu Dhabi investment fund had invested into Bidaya, which was primarily to encourage the early stage startups into fintech and other technology services. Similarly, I'm not sure if, again, many of you would have even noticed that very recently, ADIO has made an announcement and is inviting Indian startups to come in and set up a base in UAE with a promise to encourage growth, development, and helping them with access. Having said that, the second category of funds that which of course is an area of interest is the larger ticket size, which was the investment funds, mostly backed by banks out here. Again, same long-term strategy, established network. entry into those comes in with its own set of challenges, but of course they are more than happy and open to hearing out new pitches. So that's another entry point for us or an access. Similarly, the last two, which are the family offices and angel investors, which are primarily my, like you would have heard Amar mention, these are my go-to network that I have actually been tapping into, helping startup founders or investors who are looking to raise capital, open doors into the ecosystem. Lastly, just some investments, family office investments that's happened in the region. A couple of them to mention, of course, is the Huda Khatan's investment into the UK firm, which was the Uptime. Similarly, Fetcher raising $11 million in the region. So these are some remarkable transactions. I'm sure that a couple of them, it becomes a bit difficult for us to keep track of it. Then the last, the portfolio, the pool that we have access to are the angel investors, especially the smaller ticket size. They are more keen to enter at the right valuation, which is mostly the pre-seed and the seed stage, in order for them to maximize their returns. That's from my side. Sorry, I overshot by 3 minutes, Amar.
No problem. No problem. Thanks a lot, Devika. Very good insight in all the happenings happening in the Middle East. I'm sure all of us would agree that the India-Middle East corridor is clearly a strong play for the next 5 to 10 years, if not more. If there are any questions for Devika, please do drop me a message in the chat box. I'm not sure if we'll be able to take questions immediately because we're running out of time, but maybe we'll do it one-on-one. In the meanwhile, let me welcome Arnaud Girard to the floor. Arnaud is the Managing Director at Fundrock and also a member of their board execo. He has a wealth of experience on the fundraising side and has worked with a number of asset managers looking to raise funds from global markets. He's based in Luxembourg, but shuttles a lot to London and other European financial cities. If not at work, Arnaud can be found skiing in the Swiss Alps with some family office investors looking to enter emerging markets like India. Over to you, Arnaud, to talk about the fundraising opportunities in Europe.
Thank you, Amar, and privileged to be part of this first webinar of Kampani and talking to such a high audience and speakers before me. So yes, thank you for the introduction. So Fundrock Distribution, just a quick word on the firm, is a MiFID regulated entity in Europe, and you'll find out it's very important in Europe as soon as you want to touch distribution matters. We're part of the Apex Group, which I'm sure many of you know, which is a global firm involved with a lot of the structuring around fund and strategies. The raison d'être of Fundrock Distribution a few years back was to enable distribution from far afield asset managers, but also very closely based asset manager from Europe, based in Switzerland or from in the UK. And although the European Union is what come across as a very unified, similar legal framework, as you drill into the detail, there's a lot of interpretation that's done locally, making for the outsider as well as the internal players a bit of a maze to navigate. And we're here trying to help that navigation. I won't touch a lot around structuring today because my fellow speakers have touched already a lot. But there's one thing to be said about the big structure for distribution in Europe. The Rolls-Royce of structure is what we call UCITS. These are vehicles that have been designed and whose framework has been developed over many years to basically ultimately protect the retail investors. Because of the protection, because of the knowledge, because the people are accustomed to those structure, these have become the Rolls-Royce of structuring, even when you target not necessarily retail investors. Okay, and in this category, you would imagine that all European countries fare equal from a domiciliation perspective. And fortunately for some, or fortunately for others, the two biggest domiciliation for funds have been now well established as being the Ireland and Luxembourg market. These are the lion's share of new launch and the lion's share of funds that are being bought by wholesale as well as institutional. This has been, the motivation of those two successes have come from, I would say, almost habits, force of habits. has been making their life easier from a compliance perspective and due diligence perspective, and to structure that are, or to domiciliation that people have grown so accustomed to, that it is, I won't shy to say that it's a bit of a struggle to export even UCITS fund that would be domiciled in other country like Sweden or like any other Nordic region or Spain. We're talking to many clients that are considering moving the domiciliation of their fund from the local country where they started into a more Europe-wide, if not internationally wide established basis. Some of the speakers mentioned other domiciliation like Mauritius. And I know Mauritius is trying to establish itself as a center of a fund going forward. It is still difficult for Mauritius domicile fund to be successful in Europe in the main for the right or the wrong reason. And if you think of distribution being a funnel, the funnel gets reduced the more exotic your domiciliation or your structure become. As I said, the Rolls-Royce, Irish or Luxembourg base will give you the broadest application possible. And as you change your domiciliation, as you reduce the regulatory framework on the that your fund has to follow, so from a UCITS into a RIF, into an unregulated instrument, you reduce automatically the funnel of application, the funnel of investor that are interested or simply sometimes even allowed to invest in the structure. So this is the framework. Now, one of the big success of UCITS is that it exported itself outside the borders of Europe, and pretty much many countries, or Asia, Latin America, are also looking at UCITS vehicle as for them offshore a suitable vehicle. Now, looking at non-European structure, European investors have their habits in certain domiciliation like Cayman and others. Once again, these would be instruments, or these would be fund structure that are more easily accessible to first and foremost institutional investors or family office, and from a client segment perspective, or people based in Switzerland or the UK, which have, from a regulatory framework perspective, a bit more leeway or tolerance with regard to offshore vehicles. Other European countries, mostly from the EU, are quite more strict around the degree of allocation to offshore vehicles. That's another point to be made. Interestingly, because of the success in the investment space and moving gradually into investment strategy rather than structuring, private equity or liquid investments have become more popular in Europe and more popular towards the wholesale market, and there are increasing structure or product being developed along Evergreen that are trying to exploit or develop what I would call a democratization of the private equity. And when I say private equity, I'm talking more of a illiquid rather than private equity specifically. So once again, we're seeing a lot of the big players developing solutions to attract the wholesale market, which ultimately sell to retail or high net worth individual into that space, and are interested into instruments that can accommodate that. Okay. Now, I've talked so far in the webinar, and so far myself, I've talked a lot about structure. Let me talk a bit about the appetite and what strategy are people interested in. As the slide put in, we're trying to support asset managers that want to raise assets in the EU, and that comes helping in structuring, but also help them to target the right segment and the right country for their product. And once again, we're looking at a mosaic of different risk appetites in Europe, with the most, I would say, entrepreneurial or avant-garde, maybe some areas of the UK and the Nordic. In the second step, continental Europe, like France, Germany, Switzerland being outside the EU is a case in itself, but Switzerland also being quite avant-garde in what they're looking for, despite maybe the reputation of my fellow citizen being quite safe and prudent with regard to investment. Now, what we've seen following 2022 market volatility is a number of fragmentation of risk appetite or area of interest from the people that we talk to. And we talk to family office, wholesale, which I would describe as, you know, a large wealth manager or private banks, as well as institution, which I would call the insurance, the banks, the pension plans that exist back in Europe. The risk appetite has been one where it has been difficult overall for new managers to break in. First, second, those institutional investors have in the main more tempted to rebalance their portfolio than taking into new products. And finally, the Nordic have been in Europe have been the one more inclined to consider again growth strategy, whereas continental Europe has been more still looking at value and more defensive strategy. This is a trend that we've observed also coming from the US, and this is a trend that we've also been observed in the Middle East, where people have been more keen at looking at growth strategy than defensive strategy. This is not to say that continental Europe will not move again to growth. And in this very volatile environment, this is the sentiment can easily be swayed. But this is today what we're looking at. From an asset allocation perspective, it is interesting to observe that, you know, Asia is still very much, and we've seen some statistics from my fellow speakers, remains a very attractive place to invest because of the demographic, because of the economic growth relative to the European market, which is the old market, not to overuse that word. So what we had seen, I would say, until 2020, 2021, was an amalgamation of Asia as one market with almost like a laziness to allocate in single countries. Okay, I don't want to be overly generic, but there was a trend for Asia Pac, and no longer even an allocation to Japan. Now with the volatility, with the rebound of value versus growth, with the expensive the pricing and the valuation in some developed market, Japan has come back as a location. We've seen that starting in 2021, clearly accelerating in 2022. So out of that Asia, Japan has come back from somewhere that we probably didn't necessarily anticipate it, despite the dynamic of the economy, dynamic of the demography. The biggest change, and it's still, I'm being prudently saying that because it's still very much at play, is the reaction of European vis-a-vis China and India. And I would say there is clearly a dynamic that is coming from the US that maybe not is as constructive vis-a-vis China, which the Europeans are, sitting on the sideline and observing what they want to be doing and what they want to allocate. So there are still very much interest into investment in China. India, as a decoupling of China, as an alternative to China, you can frame it, you can name it as you wish, but India attracts also as the largest demography in its today's economic and geopolitical system. I think democracy still remains hopefully a very good benchmark. India remains a very attractive place for Europeans to look at, and they are looking at it quite a lot. But again, maybe more on the defensive side, start at the moment playing more with the well-known alley of investment, the liquid equity rather than the illiquid investment. Even though, once again, the demography, the economic growth supports more, is still very early days today, but many of our interlocutors, many of the family office, institutional investors that we talk to are looking at India. And to compare and contrast India with maybe more another maybe more fashionable subject, which is crypto and fintech. We have had a lot of conversation around crypto and Bitcoin and the like, but those conversations very rarely turn at the institutional level, very rarely turn into investment. Okay, whereas people invest in India, people invest in China, people invest in Indonesia, and so on. So the Indian market is being looked at prudently. In very likelihood, the European will have a tendency to favor the big players because it's a safe bet. If you, as I often say, if a product doesn't work at BlackRock, it's a shame, but you as a fund selector, you're not necessarily going to lose your job. Whereas if it doesn't work in a smaller boutique, then it's a more difficult decision to justify. This is unfortunately the reality in the business. But people are looking for good ideas. People knows that to achieve the performance on the product, on the fund, on the pension plan, they need to identify good ideas at the right valuation with the right prospect. And India is a natural place for them to invest, as long as the strategy is framed, in a packaged in the right structure that is easy for them to access, and can resist the scrutiny of due diligence and AML and KYC that nowadays we will have to go through. Maybe to finish my statement, I would just flag post financial crisis. There has been a very strict implementation of the concentration risk. So the majority of investors would now be very prudent in owning more than 10% of a fund. Okay, and that's a very strict rule that we see implemented over and over. And when we present to those investors, sometimes, very interesting ideas by all accounts, some of the ideas that would need to be talked to sophisticated investors that are typically large. That 10% rules can become an issue if you're trying to, if you invest into a niche area, however exciting that is, you may not be looking to raise hundreds and hundreds of millions. And fortunately, the people that you're going to be talking to that could be interested in and having the best background to appreciate those merits will have the 10% rules, but also so often the 25 or 30 million ticket limit to justify the due diligence cost, the process of research, which leads to a conundrum. A great idea that can only raise 50 or 70 million will struggle to raise money in Europe because of those 10%, 20% give or take ticket size. So it is very frustrating for us, the distributor, for the investor that are interested because they appreciate the value of some of those. But this is we're far away from structuring, we're far away from investment, but this is the reality on the ground that one has to take into consideration. So a lot of ideas, hopefully useful information for all of you. And as Amma said, happy to take any question and drill down.
Sure. Thanks, Arnav, for the wonderful session on the fundraising landscape in Europe. And there are a lot of historical bonds between India and Europe, and no better time than now to build on those. Would have loved to take questions, but we are pretty much out of time. I've got lots of questions on the chat box. And what we will do is we will send them across to the speakers and get the answers back across to you. I would now like to hand over Soumya, the co-founder at Kampani Capital, for the vote of thanks. Soumya, over to you.
Thank you, Amar. We would like to thank all our speakers for taking out the time to attend this webinar, and we hope they can come back soon. A big thanks to all the participants for joining in this call. Please do send in your feedback and any other questions which you may not have typed out yet to us, which we will pass it on to the speakers and we'll get them answered for you. Thanks, and we hope to come back very soon with another session on knowledge sharing, covering the Indian and the global markets. We really look forward to partnering with many of you in the journey of taking the best of India to the world and bring the best of the world to India. Thank you once again. A very good evening to you all. Have a nice evening.
Thank you.
Thank you.
Thanks. Thanks, everyone. Bye-bye.
Bye.
Thank you.
Thank you.